Welcome out to another Trading Justice podcast. This is Mark Justice. I'm joined with my brother Matt from trading.com. It's a big week coming up in the market. When I thought about this week, it's like this week matters. You got a lot of rotational aspects and some potential catalysts on the calendar. You're coming off a big Nvidia earnings and tech, maybe not as great a charts as others. Then in September, big seasonality month, right? We got some stocks to analyze and a stock to drop it. A big podcast in store for you. And this is brought to you by Tackle Trading. And we've got a big month ahead at Tackle Trading. We have a master trader event here in 2 weeks. It is our premier technical teaching event where Matt Justice, my brother, helps you become a master trader. The ability to see those charts, to be able to act upon those charts, manage your portfolio, manage your trades. It's a fantastic. I'm not just teaching master trading this month. You're taking a 3-week course on day trading. Tell me a little bit about that.
Yeah, there's a couple different things we're doing this month from an education perspective, and that's what we focus on at Tackle Trading. We like to put the education and application together, and that what equates to success. And when you're looking at those, we got Master Trader on September 15th and 16th, free for the pros. You can sign up there by hitting the link in the description below. And then for the next 3 weeks in the Coaches Show, which is Tuesday nights at 8:30 p.m. Eastern Standard Time for the pros, I'm going to be teaching a day trading course to a certain extent, walking through the basics tomorrow night. Then we'll get into some more advanced charting and techniques, day trading strategies going into the next couple weeks. And so if you're interested in learning how to trade, September is the month that all of our kids go back to school. Well, at Tackle Trading, that's for the adults. So let's go have some fun in Master Trader, day trading. And we got more webinars down the road late September as well. So if you're interested in learning how to trade, there's no better place than the 5-star rated Tackle Trading. We put the education in application. So let's have some fun today.
Yeah, absolutely. Matt, ever since 2 weeks ago in the CPI report, this market has kind of had this rotational feel. We had that CPI report came from in. It was, very, very soft or at least good enough, right? And we started to see many days where you kind of had this, feel of like, all right, tech's had this fantastic stretch, this fantastic year. Let's be honest, fantastic several years, right? And it kind of felt like the market has wanted to kind of gravitate towards the Dow, the average stock as measured by RSP, small caps, your cyclicals. It's like the market has kind of wanted to rotate there. We'll talk about tech here in a second, and we'll talk about Nvidia's here in a second. But then you had the CPI report, and then you had Jackson Hole. Now, I guess it's been 2 Fridays ago where Powell came out and said, we're going to give you some cuts, right? Kind of alluded to that. We saw a big power day. And now we're seeing some really healthy charts in certain area of the markets as we come into a catalyst-filled week, but maybe not the S&P. I think you said best when we were meeting with our pro members before the podcast. The S&P is kind of boring. Everything, all the excitement is elsewhere. Something like that.
Well, I made the comment that I felt like the S&P 500 chart discussion was a little bit boring. And it's not boring per se. I mean, we're talking about an all-time high breakout. We're talking about a potential for it to get back up above 6,500 and drive into 6,600. I mean, you can paint the technical backdrop of the S&P 500 fairly bullish here, and you could get pretty excited about some pretty decent technical conversations. But when you're talking about kind of looking at the indexes in general, and let's take all four indexes, each by themselves. When you look at the Nasdaq, for example, you're not exactly excited about the technical trend pattern, support resistance, the momentum environment. Like there's nothing that stands out technically to you.
Are you excited to go pound a trade Tuesday morning in tech?
No, I'm wondering if tech's going to hold this very important trend line on Monday
I'm
morning.
watching it.
That's what I'm interested in first and foremost. Before you talk about the ability for you to go out there and get excited for a potential trade, don't you have to hold support first? Like isn't that putting the proverbial cart before the horse? Like, are we excited about a trade in tech? Well, if support holds, A, then B, we break a high and hold that, then yeah. But even at that mark, even at that, like if support held in the Nasdaq and you confirmed upward movement in price, what are you going to be staring down the barrel of a potential 100 point before you get into the massive resistance
Yeah, you're
test?
gonna be staring at the high from Thursday before
Yeah.
then you get the high from 2 weeks ago, right? Like,
And so how I've described it as of right now, tech's not providing a tailwind, tech's not providing a headwind. There's concern in the tech landscape, and you can see this from a technical perspective. Number one, you have momentum, a loss of momentum in trend. Number two, you had a deeper pullback. Number three, you had a shallow pushback up. For those of you that don't understand technical language, I just described a head and shoulders formation, Mark. And that's kind of what we're looking at in tech. Now, does that play out where we see the ultimate breaking of the neckline and we see an ABC cycle? Like, that's in the back of my head. So, my first question on tech before you even get into the, oh my goodness, is there a great trade in tech? There's always a great trade in tech, but it's a little bit easier when you got that massive tailwind. And right now, you just don't have that in my estimation on the tech side. You could have Nvidia. You could have. We'll talk about Nvidia here in just a little bit. But then you go over and you look at kind of the other indexes, Mark. You look at the Russell 2000, for example. Well, you don't have a loss of momentum in trend. You have a higher level of resistance, a higher level of support. Consolidated for the most part last week. It's not a great technical backdrop, but you would certainly say the edge is to the bulls. You would certainly say or suggest that in general with the 2000 stocks in the Russell 2000 that it certainly has a tailwind to it right now. When you go over and you look at the Dow Jones, for example, I think the Dow Jones is very, very well behaved right now. You broke out on Jackson Hole Day, and then last week was what I call a development week. You had an oversized price response to Jackson Hole. It was fabulous on the breakout, but there was not a lot of continuation. And when you saw that there wasn't a lot of continuation on that next day, which is not surprising or shocking given the fact that you had an oversized candle on the Jackson Hole, well, what do you want to see? Do you want to see it just run because it helps your long-term investments, or do you want to see it develop into a really good tradable situation? In my estimation, it developed into a really good tradable situation, given the fact that you had 5, 6 candles now with the futures candle, all inside, all developing at the top end of the Jackson Hole candle. And when you develop high inside, what that technical comment is a high inside is when you got a momentum condition and then you develop inside the top end of the momentum candle. That is seen as good development for the bulls. That is seen as the market playing defense, just alleviating a little bit of slight extension. You don't have that slight extension going into this week. You got
Gorgeous
a
count.
pattern on a good breakout channel right there around the 750 level. That's 45, 750. But so the Dow Jones, and then when you look at the RSP, I think you could say something very similar to that of the Dow Jones. So when the NASDAQ takes a back seat, and it's certainly taking a back seat right now, the ultimate question is it rotation or is it fear? Okay, that's the ultimate question when tech does what it's doing right now. Is there just some hesitation and we're just seeing sector rotation, or are we seeing something else play out? And that something else is something along the lines of, are you seeing an ABC cycle play out in tech? Are you seeing the beginnings of a correction analysis in tech? And does that lead into everything else? As of right this very second, Mark, I would say the technical condition is strongly suggesting rotation
Yeah, I am
and not
firmly in rotation.
overall, market correction language. What's your thoughts on that?
I know I'm firmly in the rotation camp, and I felt this out. And one of the things that when you look at the charts, two big green candles, and this is why I want to talk about the labor market for the next couple minutes. The
Yeah.
last two big green candles have came on policies, CPI, Jackson Hole, right?
So,
Next up on the calendar, right? And we got a lot of minor things going on this week. The big one is the labor
well,
market.
and even before that, Mark, the labor report the time before was the kind of the epicenter of the entire technical saga that we've been dealing with. And so the biggest movements we've had about 5 days in the last month where we had movement, right, in the market. All 5 of those days were some degree of Fed driven narrative, correct?
It's
That
almost
had
like the market cares about nothing else right
I don't think it does because
now.
Mark, when you look outside that, when we didn't have CPI last week. We had PCE. Nobody cares about
Nobody
PCE.
cares.
Okay, PCE is the fourth most important report to the market. It's the first most important report to the Fed. That should tell you something. But in terms of the economic landscape last week, you didn't really have anything that moved the needle. And what did we see from a price response? Nothing really moved the needle over the last month. Labor a month ago, CPI report 3 weeks ago, Jackson Hole a week and a half ago. Well, Mark, it doesn't take a technical genius to kind of go look at when those came out. This the candle right here that we're looking at, that was the Jackson Hole candle. This is the CPI candle, and this is the labor market candle. And outside of that, you've had relatively cautious
A lot of
pricing.
theta days. A lot of
A
theta
lot
days.
of theta days, lot of theta
And so,
bleeding, no doubt about that.
and so when you look at, this coming Friday's the monthly unemployment report, we're likely to get some sizable price movement. I think the odds are stacked for the bulls on this one and everything else. Man, this could be one of those sneaky weeks where the headlines on CNBC or the headlines on whatever website you're on are like markets down, markets doing nothing, when those are not the story. Maybe tech's doing nothing, maybe the S&P 500 might be down, but you could have situations where lots of stocks are up. They're set up for breakouts heading into the labor market print. And so this, tell of two markets, we're so used to it just leading and everything else, falling behind.
What
You know,
what what two sectors gets pulled with the AI trade? That's that's the depth of the market, the breadth of the market during the tech runs. That's not happening right now.
nope.
Like right now, your average stock is setting up pretty decently right now. And so, like when you look at the indexes, it gives you a little bit of a cautious read on the Nasdaq, gives you a little bit of excitement on the ES, and it gives you a little bit of, ooh, let's get you up and go on the Dow Jones and the RSP. We don't see that type of pricing very often, and so, like when you do, I just think it pays. You got to pay attention to it when you do start to get that because if this is the beginning of a rotation, I don't think that rotation lasts long, but it would be much needed by the market. The market's not going to hate any rotation here.
Yeah, I wouldn't be surprised if we actually, because I think we're a couple weeks in. I wouldn't be surprised to see a rotation last somewhere between 5 and 7 weeks. Which can feel like an eternity if you're a trader.
Yeah, I would say mid-October. I
You
mean, if,
know,
if that's how it's
yeah,
going to play out.
that's about that timeline, right?
Well, and
And
honestly, seasonality played a little bit of role in that answer too.
and I think seasonality affects tech. And we'll get guys, but I want to give you four scenarios because, like, right now, Matt, I'm kind of in this. I'm
I think
interested in.
it's set up just the raw numbers, the expectation. I do think it's set up a little bit more for the bull than the
Oh
bear.
yeah, I think this one's like
4.3 is the expectation, so everybody's
you
already
have an
expecting
elevated unemployment number and a very modest 74,000 on the
74,000.
jobs.
Are you kidding me?
That
That's
is set up
the
for a bull.
expectation. By the way, the average is 36,000 this year so on the revisions. But average hourly earnings 0.3, 4.3, 74, all set up for the bulls in my
This is all
estimation.
set up for the bulls this week. The expectations are set up for the bulls. The charts are set up for the bulls. And I
Mhm.
think, a savvy trader has their cyclical stocks, your banking, your airlines, your industrials, your material sector, right? I
Mhm.
think you have those trades set up. And you see a trade before the labor market, take a trade. I think you have, at least this is my plan, to have an aggressive playbook if we see price confirmation and breakouts on Friday. of strength, right? I'm very,
Oh,
very much interested in those.
given the size of the last few candles that basically on every one of these Labor Days or the CPI report or anything sensitive to what the Fed's going to do in 2 weeks from now, because the Fed meets in 2 weeks from now. So obviously labor's part of that, Mark, but all four of those candles are sizable candles that finished at the top end of the candle or the bottom end. That tells me I want to be a little aggressive on the day trading side. And by the way, did I say I'm going to be teaching day trading in the coaches show this for the
Yeah.
pros?
I mean, those candles have been those days,
Let's
these
come join that one
events.
on Tuesday, guys.
Friday is most likely going to be a fantastic day trading day, as
Mhm.
these Fed-induced events have been.
There's a
Uh,
couple other reports this week that I think are good day trading events, but the granddaddy is the labor market this week. It's a
and
big
Matt, like, when you go through the bad news, good news quadrant,
one. Mhm.
I just see it overwhelmingly in the bull side. And I don't want to, nor do we have time to debate every nuance of everyone. But Matt, I mean, can you really see a scenario where bad news is bad news this week, where the numbers are so terrible that markets freak out that the Fed's behind?
Do I see a scenario where the market just sees it as bad and the reaction is bad? Right? If it's an implosion, like you'll get some Fed is late pricing in my estimation, and if the market thinks the Fed is late, usually you get some negativity on that one. Um, if it's really really robust good, honestly, I would see a doji day, honestly.
Yeah,
Given the fact that the market would be like, oh my goodness, the US economy is doing great. Oh my goodness, we're not getting cuts. Like doji day. Like I know that's kind of how I see it. On where you might see some negative response is in line, but wage growth is higher than expected.
yeah. I mean, like I can find scenarios, but I
Yeah,
don't want to
there's
give.
scenarios, but
But most of the bulk and the meat of the mill are in some
because
version of
any nasty any miss is going to be seen as just getting rate cuts.
just
Like
getting rate cuts, and
that's
maybe
how the
even more.
market cares. The market doesn't care about the actual
And if you have
U.S.
a
economy.
small beat, let's say you come in at 100,000 and you beat that, hey, economy's doing good, we're getting rate cuts. It would have to be like extreme levels, like 220,000.
Goldilocks would be a slight beat and a slight miss on wage growth.
Yeah, I think there's just more, combinations of the good stuff where you're seeing those RSP and those cyclicals and those banking and those airline stocks higher on Friday than when they started the week on Tuesday, right? I just think that, the week is set up for the bulls of those areas. Now, Matt, tech
So you think this week is set up for most scenarios to be seen through a positive lens from a labor perspective? That's how
and
you.
not necessarily in tech. I don't think tech is trading well.
But no, in the general
In
market,
the general market, your
RSP, Dow
stock,
Jones.
RSP materials, banking stocks are. Yes, I think it's set up for the bulls. I think it's the bulls who
What
lose.
scenario leads to the probability of a rate cut going lower?
200,000 job print that's hot with no downward revisions in past jobs. That would not be a great
I don't
scenario.
think the market believes those numbers if they come out.
Well, I think the algos would
I
believe
think
them.
the market sells that hard.
Yeah. Yeah. So there are,
Number one, the market wouldn't trust the data on a massive beat like that. Not against the conversation on firing the labor report number, the commissioner, and all that jazz. The I don't think that a massive beat you would have a lowering of expectations on rate
yeah,
cuts, and the market wouldn't believe the number in the first place. It would cause confusion.
that's my worst case scenario
Yeah.
is actually that type of thing. Now,
The
tech,
best number for the economy would be the worst impact for the market. And I know it's weird, but I agree with it
that's
100%.
the game we play, boys and girls. That's the game we
I
play.
think slight beat, slight miss. Like I don't think it changes the needle, and that probably sees slight appreciation on rate cut certainty. Um, I'm trying to think of a scenario where inline slight beat, slight miss causes a
That's all bulls. There's
reaction.
no
I
scenario. And
just don't
like,
see one.
you can put your academic. There are no scenarios. The slide B slide is not firmly in the bulls' camp.
Not when the market is
No,
firmly in the camp of Powell's
bulls
cutting.
window for this is like this 90%
Yeah.
window of what it could be, and it's just extremes. Like massive miss, massive beat on unemployment. That's where things will get interesting. Now, tech, on the other hand, I'm a tech trading on any of this stuff. I don't know exactly what tech's trading on, but Matt, I've seen, and I want to get your take on Nvidia's earnings because obviously it was the biggest event of last week. And I've seen 6 or 7 stories in the last month, kind of this negative Nelly type stuff towards tech. There was this MIT paper, and Sam Altman said something, and then there was a story of Facebook cutting back, and then there was the Alibaba. I want to get your take on Nvidia's earnings, and then I want to get your take on Alibaba on Friday and kind of the resurgence, at least for a day, of kind of that DeepSeek feel on Friday. So break down the video.
Well, I thought Nvidia had a very good report. Nvidia doesn't have anything other than a very good report. Let's first start with that. The bar is always high on Nvidia, and they usually beat the bar. Every other company gets judged through a different lens when it comes to earnings. Nvidia gets judged through the lens of Nvidia. They get judged through the lens of second quarter 22 report until today. And as long and that's when the AI saga started, and that's when Nvidia was having 250% year over year growth, and now we're at, you know, a paltry 56% year over year growth. Traders are spoiled. But Nvidia, I thought, had a good report. I don't think they had a great report, and there were certainly some flaws in the report. EPS beat at positive 4%. Nothing to write home about, perfectly honestly. But Nvidia once again gets judged through a different lens, and there's a billion eyes on Nvidia. So their expectations in the last year, last 5 quarters have been really, really spot on. We're talking 1, 2, 3% beats. This one came in at a 4% beat. Revenue was up 56% year over year, and it came in with the beat as well. Q3 guidance was up 1.7% at tackle trading. That's what we call the hat trick. When you beat on EPS, revenue, and forward-looking guidance, you increase it. You pull the hat trick, and Nvidia certainly did. But the context is really what matters here on Nvidia. Data center growth was the flaw. If you'll say it's a flaw, that's the flaw in the analysis on their data center, because they were expecting 41.31 and they came in at 41.1. Mark, that was a slight miss, but that slight miss when it comes to Nvidia growth, it brings in a little bit of concern. And so, in totality, I would say NVIDIA's earnings was really, really, really good. The only flaw was kind of the data center miss. But Mark, that was like 90% of NVIDIA's revenue. Data center is like the biggest strength for NVIDIA. It's what everybody believes in on the data center AI infrastructure build out. Capital returns, they authorized a new $60 billion repurchase program, which I saw a whole bunch of people on Twitter make fun of. 60 billion, boys and girls. And on the big picture, Jensen talked, and obviously everybody was talking about the miss on data center when Nvidia reported, but Jensen talked about the future a little bit, and he talked about how they're projecting $3 to $4 trillion in data center build out between now and 2030. 2030 is kind of like that target date for everybody that looks at the AI space. And it's been that way for the last couple of years. But by 2030, Jensen's expecting $3 to $4 trillion. And Mark, the thing about that $3 to $4 trillion, most of that AI build out, well, it goes to Nvidia because of their data centers, their GPUs, and so on and so forth. And one thing in their guidance that most people saw their guidance as a little bit soft, and I did as well. That's weird to say, given the fact that they increased it by 1.7% and its expectation at $54 billion. Nvidia used to be reported in the single digit billions. Now it's soft at 54 billion. But their guidance was seen as soft a little bit because, number one, it only had 1.7% expectation going into next quarter, and there's zero H20 cells going into China in their guidance. They had a $4.5 billion write down. And when it comes to that China H20 deal, that's the big question here on their guidance. That's the big question on the growth side of the equation right now with Nvidia is does the Trump administration give authorization to Nvidia to sell the H20 chip to China in return for a revenue sharing agreement that the United States government would basically be getting 15% revenue share of any H20 chip to China? If that deal goes through, and basically what the Trump administration is doing, in my estimation, is, and you heard it here first, Mark. I believe they're at the very early beginnings of building a sovereign wealth fund at the United States. And this is one of those. We saw it with Intel. We've seen it with a couple of other situations. You're seeing it here with Nvidia. If they do agree, and that would be interesting to see if Nvidia would agree to that. But if Nvidia does agree to that, and the Trump administration authorizes the H20 sell to China, I'll have a little bit of concern on the AI, total, the AI arms race with China that we're going through. But it would also represent upwards of $5 billion in revenue to Nvidia, which would be a guidance increase of close to 11% and not 1%. And if Nvidia came out last week and said we're going to increase guidance by 11%, we're gapping up 11% and we're running on that. So that's something to keep an eye on. Now, you asked a question regarding how much concern is not just the Alibaba and what they're doing. Mark, we're seeing that with other hyperscalers. Other hyperscalers are building out their own chips, and we saw Alibaba start to design their own chip, and so on and so forth. Can it have a material impact on Nvidia downstream? Of course it can. Right now, the profit margins on at Nvidia are right around 75%. That is rock star status, like rock star status. If Alibaba, for example, were to go through with their new chip and they actually bring it to market, it actually has an impact. You're talking about somewhere around 15% revenue out of Nvidia that would come out of China, and so that would have a slight impact, and profit margins would contract under 70% in that environment, maybe down to 65%. Well, let me say this right now. If that occurred, would 65% profit margin still be a good number, Mark?
Yes.
Okay, so the ultimate question would be, would 65% profit margin still justify a 30 forward PE ratio on Nvidia?
Well, I am not. This is outside of my area of expertise. I know I'm buying big dips.
Well, let me answer my rhetorical question. The answer is yes, it would. If you had 50% growth in a company and you had in that company 68% profit margin, could you justify a 28 forward PE ratio? Yeah, you
Yeah,
can.
unless China's out there slinging
Especially when the
technology for
average
free.
Mag 7 for over 10 years now, the average Mag 7, investors have been paying a 30 premium for a Mag 7 company for well over 10 years. That's what you're paying for Nvidia. So yes, I think Wall Street's being a little bit spoiled on Nvidia? Absolutely. If the AI trade wants to take a break and wants to contract, which we're seeing the early beginnings of, I'm perfectly fine with that. Let's get ready to get into the contraction territory and let's gobble up some of the best companies in the world right now. If Nvidia wants to pull back on the weekly chart, after an extension run like it's had, and it wants to pull down to 160, oh, so what? Do it. This is one of the best companies in the world, and it's going to continue to be one of the best companies in the world moving into the future. People are writing the story of Nvidia's like lack of growth. No, this is a juggernaut. They're the AI king, queen, and country, and I don't see the negativity in the analysis that others do as of right now. I don't have the fear of China. I don't have the fear of premium. I don't have the fear of competition. I don't have the fear of the hyperscalers. And the reason I don't have the fear, Mark, is because all those hyperscalers in the last 6 weeks said we're spending more money on research and development, said we're spending more money on the AI build out. We have sovereign governments literally planning on trillions of dollars in the AI build out. And the last thing I'll say about this is this, Mark, if you have sovereign nations emphasizing and putting it into a priority, the AI conversation, isn't there room for more companies than just Nvidia to dominate that space?
Yeah, yeah,
Yeah.
and
And again,
I'll
it's
take it
30
one step, like because there's been a lot, because DeepSeek in February caused some volatility, and Friday it felt
I
like the
didn't see
narrative seemed,
Baba as DeepSeek. I want to be clear on that.
yeah, it felt like Friday they were attempting to do that. Listen, until I see Saudi Arabia making deals with China and Alibaba, it's not a real narrative to me, right? Like, I mean, that's the kind of things that you need to see for this to become more than a seasonality based type pullback, which can be
Listen,
healthy.
if this was two football teams lining it up, running their own playbooks without helping each other out, I'll take the U.S. hyperscalers led by Nvidia over the Chinese hyperscalers led by Baba any day of the week, twice on Sunday. It's an easy call. That's fine. Like, yeah.
Yeah, but we could see. I mean, the technicals will talk us through this little stretch, and we'll talk about seasonality. Come,
I am more concerned on the technical side than I am the fundamental side. Like,
yeah,
I'm
and
not
so
concerned of the fundamental side.
the technicals are going to play out, but I'm not. Like, listen, like
Yeah.
I'm very much in the flow of the chart. I see trend lines break in tech. I'm going to ignore tech. And if I see breakouts in all that other
Yeah.
stuff, materials, airlines, banks, well, fortunately, I got some really premium top shelf liquor in tech, but I got about 8,000 other stocks. Well, not that many. Matt, fun fact, did you know that there are now more listed ETFs on stock exchanges than individual stocks?
I'm not surprised by that.
I ran across that stat
I
this week. There are more
I had to
ETFs
think,
than stocks now.
oh, when was it? Like 7, 8 years ago, I did a little bit of research and there was thousands of more stocks than ETFs at that
Oh,
moment.
yeah, big time.
They put them new ones out there all the time. Um, there's a couple of requests I have for ETFs. Can we get a palladium and a platinum liquid ETF? Do we need 50 Bitcoin ETFs? Can we get one for each one of the commodities? That's all I'm saying.
But yeah, it's I found it very, I think it's very it could stir a
I
whole
honestly,
conversation.
I'm not surprised, but like that's an amazing stat,
It
honestly.
is though. I thought it was really interesting. I
There
did.
are more baskets of stocks because there's always been more mutual funds than
Mhm.
individual stocks. Like if you guys understood how many mutual fund baskets there exist, tens and tens and tens of thousands. But there are now more ETFs, i.e., baskets of stocks that you can trade as an ETF than the individual component.
Interesting question, on the buy the rumor, sell the news the next 2 weeks ahead of the rate cut decision. I think it's interesting, like, because I'm definitely in the buy the rumor camp, obviously, in cyclicals and these other areas. I expect a breakout this week. I expect strong price movement. But like,
I do too.
taking profit on that basket of trades you do between now and then ahead of the Fed, yeah, I'd still let the intraday support level, and Matt's going to teach those day trading courses. Like, I'd let an intraday support level give out before I'd sell the news on that. But that's not a terrible mentality, but that's
Yeah,
more of a.
I would agree with that. Like, are we in a buy the rumor, sell the news environment? I'm not sure about
I don't
that.
know yet.
But to me, are we in a very pure technical conversation? Yeah.
Buy the rumor, and then we'll discuss sell the news
There's
here in
way
two
too many
weeks.
clean charts out there right now to
But
to
not like tech,
any
like
other
I'm firmly in this. Like, if we don't get a pullback in tech, I'll actually be surprised. Like, and if we don't see a break,
I want to hit a pullback in tech. Like,
and if we don't get a breakout in the other things, I'll be surprised about that as well. It smells like 2021. Go look at your 2021 charts.
I would like, let me just ask you a question, and let me ask the team a question here. Would Would anybody hate a correction in tech after the recent runs we've seen in tech? I I
I mean, I wouldn't,
I want
but I'm not overweight. So
well, that's what slowing momentum has a tendency to do. It kind of cures up that waiting issue, no doubt. But I want to hate it. You don't have good pricing right now. You take the Nasdaq for example. There's not the great pricing right here. You look at Nvidia. Nvidia's got a nice little double top, double bottom situation. To break 170, you're talking about a correction. I don't think a correction would be the worst thing for tech. The only thing I just don't think you're going to see the Dow Jones run up while tech goes down. Like if you're going to get your momentum condition in the Dow, it's going to be because tech takes a break, doesn't profit take. So it'll be interesting, but I wouldn't mind a pullback in tech. I don't think that's bad. There's a couple stocks that I wouldn't mind picking up, quite frankly.
yeah, go study like February, March 2021 at home if you want something boring to do on a Monday, Tuesday, or Wednesday night. You'll see tech pull back. You'll see other things do well. It's been a while since we had a rotational market, but part of a bull market. Part of a bull market. All right, man. I got a few. Let's do another segment. Let's do a stock it or drop it. I got a few stocks for
Okay.
you.
Okay.
Are you
Tim,
ready?
you got to play. Team, you got to play. Stock it or drop it. Okay.
You know, I am going to start off with MetLife. I was tempted to go Citi, but you talked about that on Trade Masters this last week. Really like finance, really like cyclicals heading into the week, me personally, but I don't play stock it or drop it. So I'm going to make you go between Citi and MetLife. You got to only stock one. You got to kick the other one out. I know in real life, you don't have to do that. You can,
So wait, stock it or drop it? I'm going City versus Met.
I know I'm throwing a twist at you. You got Citi and MetLife. You can only do one.
Okay.
You can
Okay.
only stock one. Because
This,
they're
this
both stock it, right? They're both stock it,
yeah, I think they're stocking for different reasons, but you
and
take
that's what I want you to get at.
you take MetLife for example, real good mid-tier situation. Hesitation last week after a very strong candle on the weekly chart the week before. That's never going to be a bad thing when you take a week off after a parabolic move as you did on their earnings. Like that's going to be seen through the lens of positive development, quite frankly. That looks pretty good on swing to position analysis, and MetLife never really has a negative valuation conversation. I haven't looked at their valuation, but if it does, I would be a little bit surprised. On Citi, I thought Citi had a pretty good earnings in the first week of earnings season. I thought they had one of the better earnings out of the financial space. Well, not out of the financial space, but out of the big money center banks. And Citi, I think, has a really good, compelling technical story. You look at the daily chart, constructive consolidation over the last month. You look at the weekly chart, that constructive consolidation has done nothing but allow that 90 MA on the weekly chart to catch up. Now you're looking at a potential breakout. But when you're looking at Citi, the reason I would say stock it on Citi over Met is Met, you have levels that you have to track on Met, and you really only got about 4 points before you can get into some nasty resistance levels. Whereas on City, it's kind of open season here. You look at the long-term chart, we're breaking through some barriers that have really stopped City's growth for 10 consecutive years. You're now developing on top of those levels. And although I think it's crazy talk to suggest that Citi's ever going to repeat the saga before the subprime meltdown, but the point in bringing up the weekly chart is to look back to the left and be like, there's just not a lot there. There's just not a
You
lot.
might as well be dealing with an all-time high breakout
Yes,
for all practical purposes.
I agree. I agree. But visually, whether you're right or wrong, traders are going to look to the left of the chart. They're going to see that through the open air lens. And open air can be through pockets, it can be through all-time high breaks. But the key point is it's open air. When you come into Met, and again, I really like the development on Met, but when you look at Met, you come out to the longer term charts. like you break out of 82, like you're running 86. Yeah, I mean, that's a good trade, maybe 85, 86, 3, 4 points, but that's what your expectation is. It's 3 to 4 points. It's nothing more than that. You got a little bit more expectation. And so on if you're looking at, similar price points, one's 97, one's 82, one has open air, one has max out 4 points. Like, yeah, I'll go stock it on Citi.
All right. Love that analysis. Same game. Stock it or drop it. Snowflake versus CrowdStrike. Can only stock one.
Oh, do I have to stock one?
No, you do not. You
Um,
can't. The only parameter you can't stock it to.
and
You
I'm
can
trying
drop both.
not to do stock it or drop it from a swing trader's perspective. I'm trying to look at it through a little bit of a longer term lens here as well. I have concern on both, and it's the
Interesting.
exact same concern. Now, I will say Snowflake is a AI gold rush stock. They're one of the AI names in the financial space that are doing some really, really good things. And Snowflake had a pretty decent earnings report. They had like a 30% beat on EPS expectation. It was a really good report, gapped up, ran away from the gap. When you look at CrowdStrike, and I was looking at the numbers earlier today. Let me hurry and take a quick peek at them. CrowdStrike beat by 12%. Revenue was up 21%. Guidance was up 3% on the EPS for quarter three, and it was decreased for the fiscal year 26 and +5 for EPS. So revenue was downgraded, EPS was upgraded basically. So mixed guidance report. Now, CrowdStrike's kind of dancing that 200-day number. Snowflake's gapping out. If I was looking at it from a tradable situation, I would say put Snowflake on the radar on a watch list, wait for secondary development because Snowflake has a decent momentum condition. If I was looking at a position trade and I was like, okay, give me CrowdStrike development at the 200-day moving average, I think both have an argument for that. I'm gonna have to say drop it though on both of them, Mark. And the reason I'm
Okay.
gonna say that is I only see Snowflake through the trader's lens, and I only see CrowdStrike through the trader's lens, and as such, both of them have horrific valuations. And so when you talk about Nvidia, we talk for 10, 15 minutes about Nvidia. And my whole point in Nvidia is you can talk about whatever you want, you can parse whatever you want out of Nvidia's earnings, but at the end of the day, you're paying 28 forward PE ratio right now. You can't convince me that a 28 PE ratio on the forward PE ratio on Nvidia is overvalued. You cannot convince me on that. But with where let's pull up CrowdStrike real quick. CrowdStrike's got an 89 forward PE ratio. Mark, they don't even have a PE ratio. They don't even have a PEG ratio. Snowflake has 144 forward PE ratio. So when you talk to me about valuation issues, yeah, it's not
This is
Nvidia.
master segment.
It's not Nvidia that should get your first conversation. It's not the king of AI that owns GPUs that is in the epicenter, not the outskirts, but the epicenter of the AI build out, which represents trillions and trillions and trillions of dollars. No, it's CrowdStrike's 89 forward PE ratio and Snowflake's 144 PE ratio that is a little bit more concerning. So I'm going to drop it from a valuation perspective, but I wouldn't mind.
This is why I love doing stock it or drop it with you because I never know exactly where you're going to take it. I did not expect you to take this angle. I thought it was fantastic. Next one, Newmont Mining versus Wheaton Precious Metals.
Forward PE
Oh,
ratio,
that's
Snowflake's
ridiculous.
100. Newmont Mining, a company I absolutely love, versus WPM, a company I have a lot of appreciation for. You're not going to find the valuation problems on either
No.
one of these, in my estimation. Um, uh, I'm going to have to say Newmont. They had Newmont Mining, and I'd stock both, honestly.
Yeah.
I'd stock both, but Newmont Mining was the stock that triggered the gold stock run. They were the stock The reason everybody at Tackle Trading is making money on gold stocks right now, the reason everybody at Tackle Trading is excited about gold stocks right now, the reason everybody at Tackle Trading is like go 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 on every gold stock right now, the reason me and Frank are complaining about our covered call on KGC right now. Well, actually, that was last week, but the reason is Newmont Mining. Newmont Mining had that rock star hat trick report from over a month ago, Mark. And from that point on, guess what? GDX broke out. GDX hasn't stopped. GDX hasn't stopped. We drilled the breakout after Newmont. We drilled the breakout after that secondary consolidation. GDX is just a giddy up and go, 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 baby. That's what we're talking about with the gold stocks at Tackle Trading. And if you want to learn how to do that, you want to have that conversation, well, all you have to do is sign up for a free trial and come be a pro member of Tackle Trading. I promise you, people have paid for years of their pro membership at Tackle Trading just on these gold stocks, what they've been doing. And so when you're looking at the gold stocks, Mark, there's not a gold stock you can tell me I want to stock it right now. But Newmont Mining, they're the epicenter of the run, baby. No, it's going to be Newmont Mining or
Bonus
Wheat Crush.
question, not stock it or drop it. What is gold? Because gold's up, big on as we're doing this podcast as we head into the open on Tuesday. What's gold sniffing out?
The fact that the United States government has dedicated the only way to solve their debt problem is to try to grow out of it, and they're calling a spade a spade.
I think that's what I thought too. You and I didn't talk about this over the weekend. That's what I thought too. I just was curious if that.
I just think they're sniffing out sovereign debt problems. I would say that on the U.S. and then you got some things happening in Europe that is probably having an impact on this too. But get me talking about the European debt problem, and that'll just get me excited about gold there too. So gold's got real momentum. Silver's got real momentum right now. What's the epicenter of the momentum? I don't know. I don't care. Just keep on running. I will say this about silver. I don't think silver stops this conversation until we ding a specific number, and that specific number is 49.82. Drill that number, and then we'll have a different conversation.
Yeah. No, you nailed this recent breakout. In the pro membership, we do something called the Traders Lounge. On Thursday, before it broke out on Friday, Matt was basically prepping everyone for a breakout.
I'm saying do it. I'm saying
this is one of the many reasons to be a pro member.
I'm never going to come out and just say you got to do this. Like that's not what we do.
Yeah, like I know Matt talked, and it was might as well been. Yeah, you go do this.
My way, I definitely.
Because I tried to move him along from the silver conversation. He's like, no, we're not done yet. We're not done yet. We still got a little,
talk more about it. I want to talk.
All right, final one. Best Buy versus Dick's Sporting Goods, or screw it all. Just give me Walmart at the 200. Stock it or drop it.
Best Buy.
There were a lot of retail earnings this week, and a lot of lukewarm response to those retail earnings.
A lot of lukewarm responses to their earnings. Best Buy versus
Dick's Sporting Goods.
Dick's versus.
Just screw it all. Let's not make it complicated. Give me Walmart at the 200.
This ain't hard. Dick's lowered. Dick's lowered guidance by about 2%. Best Buy had a little bit of a similar situation. Walmart had some concern. I can't remember exactly what the concern was, but they had a pretty decent earnings. I would blindly take Walmart over those other two.
Yeah, I think this setup on Walmart's juicy, right? And this leads us into our final segment, Coach's Corner. And I got several variations of the following question. And, one, because, and the question was around tariffs. We had this big court ruling on tariffs Friday after the bell. And basically the various questions were, what does this mean? What are we going to see? The first thing I thought is like Walmart's going to pop on
court case.
Yeah, but will you summarize the court case on tariffs that after the bell on Friday? I guess the appellate court is like market conscious now these days.
I swear to heaven. So I just got done writing the newsletter on Friday, right?
Like and literally just done.
Like literally seconds before I just got done. I posted the announcement to our pros in Discord. And I sat down and I breathed a sigh of relief because the newsletters, it's a beast, man. It's a beast. 3 videos, 5 write-ups usually. We put 4 in this one, just getting everything dialed in. And I was like, oh man, thank goodness we're done with the newsletter. Now let's relax on a Friday night, right? Let's just relax. And all of a sudden I go to Twitter or X, okay? As I want to do, as I like to kind of zone out, just scrolling, right? We all do that. And I saw a headline: the appellate court rules against Trump. And I'm like, wait a second, hold on. The appellate court ruled that Trump's like 70%, about 70% of Trump's tariffs are illegal. And this court case it's an appellate court case. The next step is the Supreme Court, and it will be heard by the Supreme Court in the next 6 weeks, in my opinion. Because the appellate court said by October, you basically got to figure out what you're doing and unwind those tariffs, right? We're going to leave the tariffs on for now, but you got to unwind them by October. Well, the Trump administration isn't going to unwind anything. They're going to go to the Supreme Court, and they're going to file a brief with the Supreme Court. Well, the ultimate question is, well, not the question, but what the appellate court ruled is, according to the United States Constitution, and this is something that I studied back in law school, Mark. One of my emphasis in law school was on the constitutional law. You know this about me, and so does everybody else at Tackle Trading. I love talking about our founders, talking about the Constitution. I have obviously a lot of strong opinions on that. But according to the United States Constitution, ruled the appellate court that the authority to levy tariffs is written in plain English in the United States Congress, that the United States Congress is the party responsible to levy taxation, and tariffs are a form of taxation. And so the appellate court said, you do not have that authority. And Congress, this is the key point, and Congress never gave you that authority. See, Congress can give that authority to the president through emergency declarations. Congress never declared one. The presidency did. The executive branch did. The executive said there's an emergency. Thus, I'm going to have these powers. I'm going to put out these proposals. I'm going to do these policies. And the appellate court ruled against that. Well, that is going to go to the Supreme Court. And it's going to be very interesting. Now, how is the Supreme Court going to rule? If I had to say, because I've seen a lot of people be like, well, Trump owns the Supreme Court, right? 6-3 edge there. Mark, it is so clear in the United States Constitution who is the responsible party for tariffs and taxation. That's the United States Congress. So my question is, why don't you just get Congress to act here? Like, Trump owns the House. Wouldn't you agree with that?
Oh yeah, I know the House does this.
Why not just get it to act? Then move on. Just move on. But they obviously have chosen a different route there. And so ultimately, I don't think this has a massive market implication, quite frankly, not until we see this go further down the road, because there could be a lot of variables, including, you could, for example, probably do a tremendous amount through other authorizations, through national security.
Yeah, we wrote about this in the newsletter like 3 months ago, that if the tariffs were to get struck down.
At the end of the day, I do believe the Supreme Court will rule against the president, because I do believe it is very clear. I do not believe there's an argument against it. I really don't. But why wouldn't there be a bigger market implication is because the president would just go to Congress after that and either get an emergency declaration or have Congress put it into law. Now, ultimately, I think the president's going to hate that, given the fact that he uses tariffs as a negotiation tool. So I don't think it's complicated. I really don't. I think anybody that understands the Constitution, how it's written, understands this. But at the end of the day, I don't see a large market impact until we go through the Supreme Court. And then even after the Supreme Court, there's other ways of doing this. So I'm not sure how big market impact it will have.
Yeah, I watched Bitcoin for like 3 hours after the ruling. I think it moved like 0.0003.
I think it's fascinating constitutional law story. I think people who care about Supreme Court precedent and constitutional law are going to geek out over this one. I think it's going to get a lot of publicity and a lot of ink, and it's going to be drama. And I'm gonna love the telling of the story. Like I geek out on stuff like that. But for the market, the average market participant, I see this more as a fascinating constitutional law saga than a major market story as of right now.
Yeah. Last question.
Long-winded answer.
Oh no! Listen. I don't think anyone minds that tariffs is towards the end of a podcast and not the feature presentation. After all the tariff,
if you were to ask me that first, it would have been a 5-second answer.
Your first thought was go Twitter. My first thought was like, I don't care what it is. We're not doing a feature segment on the podcast on tariffs.
I'm so sick of tariffs. like they're here. Let's move on.
All right. What is very interesting, and if there wasn't all of these other things like the Fed in motion, moving certain area markets, and then Nvidia, a segment on seasonality would have been a worthwhile feature presentation as we start in the month of September. Got several questions along the lines of, Matt, Mark, what role do you put on, the seasonality weakness that is generating a lot of headlines? Because there's a lot of headlines. It's a very well-known fact. September is a month that hasn't been great in tech. In fact, when you look at tech specifically over the last 5 years, it was up. But Matt, let me give you the 4 previous years in September. Tech down 5%, down 11%, down 6%, down 6%, right? September has not been kind to tech, not been kind to the markets as a whole historically. What role do you put on September? What do you make out of this right now, Matt?
In the back of my head, in the back of my thought process, it's certainly there. September is widely known as the worst month for any market, quite frankly. You look at September, the Dow Jones, S&P 500, NASDAQ, Russell 2000. It's the only month of any index that has a negative impact across the space, okay? Across any index. No other sector has that, or no other index has that in any one month except September. And it's also why we typically get a beautiful Santa Claus rally from mid-October through mid-December, is because you come through a correction in September oftentimes. And so how much thought do I give to it? It's in the back of my head to the point where,
yeah, me too.
Tech's already a little bit negative. We're seeing that already play out in the marketplace. And so, yeah, it's in the back of my head. But at the end of the day, like, am I anchoring to it? No, because let me give you one stat on this. If the market is above the 200-day moving average versus if the market is underneath the 200-day moving average in September, the numbers are vastly different. Vastly different. All of a sudden, if the market is above the 200-day moving average going into September, September has very little impact on any seasonality. But Mark, you cannot, the one thing about the seasonality is there's a few Septembers that were under the 200-day moving average that we saw 30% downward movement in price, i.e. 2008, for example. And so, yeah, it does give a little bit of pause, especially on tech. For tech specifically a little bit.
And that's what it is like yeah, that's where I am too. Like tech, tech's like, oh, those charts are
2 minutes. Tech's already showing hesitation, and tech already has some very negativity in seasonality. Like, tech is the problem here on seasonality in September. Since the data was collected, a 35% win rate on tech in September. 35%. Mark, they lead the market 80% of the time. Tech does. When they don't, September. What are we going into? September. Yeah. And so I don't bank on seasonality, but I think seasonality is important to have an understanding that this does play out. And in average times, tech has an average September. And so I don't know if you can go into September saying, seasonality is going to have a massive role, or seasonality is not going to have a massive role. Let's let it play out. It's in the back of your mind. But I do think where it really does kind of impact me personally is the tech side of the equation, because tech's already weak going into September. Well, I shouldn't say weak, weaker than it usually is going into September.
And it's certainly weak
And
relative to
September
the other areas of the
numbers
market.
are terrible for tech. Like, Mark, the average sector is like negative point, 0.5. Yeah, even in the aggressive sectors, communication 1.2%, discretion 1.4%, tech 2.3%. And so, yeah, tech's had a massive run. I think that's why I keep saying, like, I wouldn't mind a correction here. I wouldn't mind a correction in tech. And why not do it in September? Get us in. Like, let's just allow seasonality to play out here, boys and
Just
girls.
let it do it.
Like, correction September, Santa Claus rally in October and through December. Let's giddy up and go.
I think that's how this plays out. I do. I think you have relative strength. I mean,
Set
this
up
is the
that
play,
way.
but I think you have relative strength in the cyclicals, everything through mid-October. Tech pulls back, markets do nothing, and then everything sets up for end of the year, general great seasonality as those flows come into the market towards the end of the year. Matt, it's been a great podcast, bro. Wrap us up. Be sure to highlight that day trading. Friday's going to be a fantastic. There's going to be other great day trading. Talk again about that class you're teaching.
Well, I'm going to be teaching two classes at Tackle Trading this month. One is going to be the day trading class that I'm going to teach over the next 3 weeks in the Coaches Show. That's going to be each Tuesday at 8:30 p.m. Eastern Standard Time for the next 3 weeks. Once again, that's each Tuesday during the Coaches Show. So you only have to be a pro member to come to that Coaches Show, and we're going to have a lot of fun teaching day trading and have a lot of fun with the team. The second one is the Master Trader Live Workshop, which is September 15th and 16th. And in that, I'm going to be teaching technical analysis for 2 sessions in Master Trader coming up in a couple weeks. You have to be a pro member to attend Master Trader. We do it for our pros every single month. But this is why being a pro member is so fantastic. You get education, you get application, you name it, you have it. There's a tremendous amount of classes you can take. We do a tremendous amount of hangouts and streams and lounges with our team from an application perspective. You got the newsletter, the traders report, you got all the education we do. It's a wonderful time to be a pro member at Tackle Trading. And September, once again, it is education month at Tackle Trading. The kids are going back to school. So are we at Tackle Trading. And so let's get it done. Let's get it done the right way. And so if you're not a pro member, you can get a free trial there by hitting the link in the description below. And we'll see you in the pros. Guys, I hope everybody has a wonderful, wonderful rest of your day. If you love the podcast, hit that like. Tell somebody about it. Help us spread the good word of tackle trading in general and the Trading Justice podcast specifically. And once again, have a wonderful, wonderful rest of your week. And if you need anything from the team, get us in Discord, or you can hit us up at team@tackletrading.com.
All right. Have a great week, everyone.